Hi everyone, welcome back to my channel. In today's session, I would discuss more about what hedge funds are all about. In the last session, we understood what mutual funds are and what are the features of a mutual fund. Today, I would explain you about the hedge funds. So, what are the hedge funds? So, hedge funds are nothing but they are the alternative investment vehicles which invest into various like securities, same like mutual funds. The only different we will understand how it is different from the mutual fund when we discuss about the features. So first thing is very common, similar to mutual fund. It is also like pool of money. So any hedge fund pools money from the different investors. They are less regulated when compared to a mutual fund. As we discussed in the mutual fund, it is very highly regulated. They have to publish a lot of reports, right? But in case of hedge funds, they are like less regulated comparatively. Or in simple terms, we can also say they are like very transparent to their investors, but not to the outsiders. They have to do everything. A lot of filings would be there, but that is happening between the government and the hedge funds, and they are very transparent to the investors also, but not to the outside world. Moving on, investor base, like what kind of investors would invest into a typical hedge fund. So here the condition is only accredited investors can invest into that. Who are the accredited investors? So it has certain criteria. It has some definition. Okay, in the US perspective, if I have to talk how it is defined as like there is some income criteria they need to fulfill, there is some net worth they need to maintain, and there is some kind of qualification and licenses certifications one should have in order to be called as accredited investors. How it is defined? Why it is defined? It's because of the like kind of risk they can take it, because these are very risky things. Moving on, what is the minimum investment? In mutual fund, we saw that the minimum investment was only 500 rupees in India terms, and we are talking about like in US terms, it was like 50 to $100. But here it's not the case. The minimum investment itself is a 1 million, as an example, $1 million. So minimum investment required is very high, up to 1 million. Moving on to the liquidity. In the previous video, we also understood what liquidity means. Liquidity is nothing but the how easily you can convert your shares or any kind of securities or the units into cash. So talking about the liquidity, hedge funds are not so liquid compared to mutual funds. Okay, they are less liquid in nature because they have some kind of lock-in period. When I say lock-in period, it's a kind of minimum period one needs to like keep their investment into. Maybe like 1 year, at least minimum period it would be. Some funds have 3 years lock-in period also. And the purpose of having the lock-in is to enable the investment managers to get the like maximize the profit as much as they can. Moving on to the like risk profile. Out of all alternative investments, hedge funds are considered to be the very risky. Now the question comes, what makes them risky? Okay, so our simple answer to that question is hedge funds are very risky because of their investment. They invest into risky securities. They do a lot of short sellings. Okay, they invest into the derivatives, different kind of complex derivative. They make the investment like IRS, CDS, and different types of derivatives. And also they take a lot of like loans, leverage, which makes them more like vulnerable and more risky in terms of when compared to mutual funds. Moving on to the like management, who is responsible or who takes care. Similar to the mutual fund, these are also managed by professional investment managers who are very qualified. When compared to like mutual fund managers, they need to be like more qualified. The reason is the kind of investment they are making. They invest into like more complex securities, more complex structures we have in the hedge funds. Okay, so that's the reason comparatively if you are talking about with the mutual fund, these fund managers has to be more like well versed about the market, about the different regions globally also. Okay, Moving on to the last thing about fees is similar to the mutual fund. Hedge funds also have a lot of fees. Okay, but compared to mutual funds, again, their fees are very high, because if you talk about usually we talk about like a concept of 2 and 20, 2% and 20%. So it's very like a famous thing when we talk about any hedge funds. So two is nothing but it's the management fees which an investment manager charges for running the operations of the fund, and 20 is nothing but it's a performance fees. So it's management fees, and this is performance fees. Apart from this, a hedge fund can have lot of other fees also. As we discussed in the mutual fund, same thing here also. Administration charges, audit fees, tax fees, legal charges, and there are a lot of other associated like redemption fees might be there. And if you're talking about the various types of the hedge funds, so hedge funds like broadly, there can be hedge funds with a commitment also, where all the like investors have to give the minimum commitment to the fund, even though they are not being called at the inception of the fund. And there can be other funds which are like open-ended, and in which they can be called capital, as and when required anybody can come into the fund and anybody can exit. Thank you so much for watching this, and in the next video I would be explaining about the very important term into the fund accounting industry, that is the private equity funds. Thank you, and do subscribe and share with your friends.